Matt, thanks for joining us. Before you were the metaverse expert, you were the expert in the streaming wars. And I'm so curious to hear what you think about how these Netflix numbers might reflect on Netflix's competition. Do you think that the other streamers have gained market share, or do you think we're going to see them all report lower sub numbers this quarter?
I think we can tell that there's some compression or slowing to growth as we get out of the pandemic. It's important to emphasize that the tailwinds lasted a lot longer than we anticipated. You can go back to the second quarter of 2020, and Reed had said Q3 is going to be light during a pull forward. Q3 was huge. Q4 was huge. Most of the next year was still significant, even as Disney lightened in Q1 of 2021. So we should expect a slowing. The more important thing is, as a strategist and a former competitor to Netflix, first mover advantages, recommendations, scale, all of those matter a ton. But ultimately, this is a content game. And I think consumers and certainly analysts are right to say that Netflix's quality of content has not met the mark in contrast to its peers over the past 3 years.
So I'm curious to hear a little bit more about that quality of content question. You wrote a lot about this, some fascinating essays about these streaming wars and content spend. Netflix is spending a ton on content, but there's this question of how they're spending it. What do you make of these high-profile deals they've made with content creators such as Shonda Rhimes, and also the fact that they don't have a lot of that IP, those characters and franchises that have proven so valuable to rivals such as Disney+?
They don't have the intellectual property. That's a solvable problem. But if we saw through last year, there were a number of high-profile attempts. Jupiter's Legacy was canceled, I believe, within 3 weeks after its premiere. Cowboy Bebop, another signature release, also canceled within 30 days. The problem is that spending is a bit of a red herring. And you can see this from the fact that in 10 years, we will still be rewatching the $200 million first season of The Mandalorian. That is properly capitalized content investments. But when Netflix spends $250 million on Jupiter's Legacy and it's canceled within 30 days, not only is it a disappointment, but that's just OpEx. It's out the door. It does not have residual value. And so there's both a lack of intellectual property, but also poor capitalization for the investment they're making today.
Matthew, I was reading one of your great essays last night, and you talked a lot about sort of that backlog of content and how that could keep down the churn and how that keeps customers, and as you were just saying, keeps customers on the platform. Though Netflix has lost a considerable amount of that to some of the competitors. How are you looking at that, and how do you, is that another direction that Netflix starts to go in, beefing up again on some of that backlog of content, though the licensing, who knows if people want to give it back to them?
I think the challenge with that is most third-party estimates show that Netflix has outstanding churn, roughly 2.5% to 2.8% per month. Disney Plus sitting at 4.5%. Its lagging peers at 6% to 8%. It's hard for the churn to get much lower. The problem is 2.5% on their subscribers is still significant, and if growth slows, you're going to see persistent declines. We know what solves for growth. It is high-quality TV. Reed is right to talk about 800 million ex-China pay TV homes. Eventually, 1 billion is the consensus among many, such as former Warner Media CEO Jason Kilar. But those people are going to come in from new original content. And that's where the supply has become more scarce. And HBO Max, Disney are outstanding right now.